All right, welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm here with Renji Matthew. And on today's episode, we're going to be talking about a little known retirement secret called the TFRA, the tax-free retirement account. We're going to talk about, other traditional retirement accounts like 401ks and Roth IRAs and regular IRAs. But we're also going to talk about the TFRA and what it is, how it works, and most importantly, like how to know if it's right for you or something that you should consider. So, Renji, if you want to get us started and kick us off, let's start talking about the TFRA and kind of how it works.
Yeah, so we've talked about secure tax-free retirement accounts in the past. We love to talk about secure accounts, be it tax-free or tax-deferred. Today we're going to focus on one of the tax-free options, which is a TFRA or tax-free retirement account. So the reason we like to focus on this is we've talked about taxes and how back when 401ks and IRAs were created, the reason behind it was because taxes were so high. I'll actually share my screen and I will talk about, bring up the screen to show you what it looks like. Okay, so Kyle, can you see my screen?
Yeah, we can. Yep.
Okay, so this
Do you
is
want to go
what,
full screen with it or no?
yeah, I guess we can.
Either way works, but I think that might just help. If you did you figure it out? If you click in the top right, well, you see where it's got that little down arrow? That works.
Yeah, this way I can pull it up, pull to the next thing.
That works.
Okay, so this is showing historically what the taxes were like. And back when 401ks and IRAs were created, it was back in the late 60s, early 70s. And at that time, taxes were in the 70 percentile. It was actually higher before that, and this was because it was right after the World War II, and they needed to increase taxes to replenish the economy. So right now, historically, taxes are in the lowest side of history. The problem is if you keep deferring taxes now, it doesn't make as much sense because our national debt right now is, I think this is actually closer to 34 trillion now and rising, right? And the only way to pay that debt down is by increasing taxes. Because unless you know somebody that's a trillionaire that comes out of nowhere and wants to pay down our national debt, that's not going to happen, right? So the only way to pay that down is by increasing taxes. So something we like to ask our clients, would you rather pay tax on the seed or on the harvest? And when we say paying tax on the harvest, that's a traditional 401k or an IRA. Let's say your account grew to a couple $1,000,000. You don't forget that you still have to pay the government their part, right? So part of that is not yours. But if you paid it on the seed, which is kind of like a Roth IRA or a TFRA, no matter what it grows to, it's yours. You don't have to worry about giving your, a cut to the government anymore. And we've talked about the tax codes and how there's about 6,700 pages, but with the rules and regulations and everything that they've added, there's over 77,000 pages in the IRS tax codes. And out of those, there's three buckets. One is tax now, which is where brokerages, stocks, bonds, income also falls in here. Then there's tax deferred. This is where traditional retirement plans like 401ks, IRAs, 403, TSP annuities, all of these fall into place. Those are all tax codes. Then the tax-free is Roth IRAs, TFRAs, and different things like that. And something we've talked about in the past, the IRS tax code is 7702, what allows you to put money into life insurance, right? And I'm going to stop sharing for a second so we can talk about it. So with the only reason you're using life insurance is because it's under the umbrella of insurance. You can put money in and let it grow tax free. Because outside of insurance, The only other thing that can grow where the government won't tax you is a Roth IRA. Everything else where there's growth, you have to pay tax on it. So that's why we use it. And because if you've heard of LIRPs, which stands for Life Insurance Retirement Plans, the reason back in the day only the rich used it is because the fees were so high, so only the rich could afford it. But now insurance companies have come out with several products because they thought, hey, why don't we come up with something for the everyday people? That way we can help more people and we make more money. And that's why they came out with, there's different types. The two most common that we talk about are modern whole life and index universal life. And the biggest difference is modern whole life is more dividend-based investing, so they're paying a percentage every year depending on how the insurance company does. And then there's index universal life, which is what we're going to focus on in this podcast, which is indexing with the market. So what that means is you're not actually in the market, but you're mirroring what the market does. So you get the growth without the losses. But either scenario, because it's under the umbrella of insurance, you're growing your money tax free and protected. Before we go any further, Kyle, is there anything you want to add or anything like that in there?
No, I think you're doing a good job on hitting and everything. And I'm not sure if you were going to cover this or not, but just continue on, and then I'll add my 2 cents in as I see needed.
Okay. So some examples, I'll show you some examples of people using this. I'll share my screen again. Okay, so this example, it just shows executives in General Electric using a traditional their traditional retirement plans and life insurance retirement plans. Here, they don't have to worry about taxes or the market. They're protected in the market. Here, they have to go through market volatility and they have to pay taxes. So you see why there's 27 times more amount money in here because they don't have to worry about taxes first off, and their money's protected from the market, right? So, and this is another one for you football fans. Coach Harbaugh, this article is from 2017, back when he was with University of Michigan, and back then he was one of the highest paid college football coaches. And he talked about how he was putting a lot of his money into index universal life product. And the thing is, a lot of people use these products, they just don't talk about it a lot. Something else to look at, if you look up BOLI, which stands for Bank Owned Life Insurance, banks like Bank of America, Chase, Citi, Wells Fargo, banks put billions, billions with a B, every year into life insurance products, and they call it bank-owned life insurance or BOLI because they're also trying to protect, hedge because they do different things. They put money in the market. They give your money back to yourself as loans, and they also put money into bank-owned life insurance because they're doing different things. They're putting their eggs in different baskets, right? This way, they're also protecting their money and they're growing it tax-free. And then we talked about rich people using these in the past. Examples right here. Ray Kroc, Walt Disney, J.C. Penney, they had life insurance policies that they had cash value in that they took out of, and that's how they started these businesses. So if they can do it, why not us, right? So that's what we talk about using is these life insurance retirement plans. That way you can access it right away instead of waiting until traditional retirement plans like 59 and a half. I'm going to stop share so see me again. But yeah, because traditional retirement plans like 401ks and IRAs, you have to wait till 59 and a half to access it without a penalty. And even then, you have to worry about taxes. And on top of that, you have to worry about what the market's doing. With these, you don't have to worry about taxes because it's under the umbrella of insurance. You don't have to worry about market volatility because you're not actually in the market, you're mirroring the market. And you don't have to worry about waiting till 59 and a half. You can access the money when there's cash value in there. So let's say going back to what we talk about a lot on this is passive income. Let's say there's something you want some kind of asset you want to buy. You can save money into these accounts. Let's say you waited a year or two and now you know exactly what you want to get. You can take the money and go put it into that asset instead of waiting till 59 and a half to access it. So there's so many ways we teach on how to use these. Before I go any further, Kyle, though, do you have anything to add on to that or a different perspective you want to talk about or anything?
Yeah, I was just going to bring up and mention the five pillars. We've talked about it before. The five pillars that we educate um, that you should analyze and look at before you ever make any financial decision with your money is safety, liquidity, rate of return, taxation, and fees. So if we're comparing 401ks to Roth IRAs to the TFRA, which of those three are safe? 401ks and Roth IRAs aren't safe because they're fully exposed to the market, right? So if the market crashes, your accounts are going to crash with the market. Inside of the TFRA, because it's under the umbrella of life insurance, you're not exposed to any market risks or market crashes. So your money is not going to go down 40% like it did in 2008, like it would have with the 401k or the Roth IRA. Next pillar is safety, liquidity. In 401ks and Roth IRAs, Renji was just talking about it, your money inside of those accounts are pretty much tied up until you're the age of 59 and a half. You can access it before the age of 59 and a half, but you're either going to be taxed and or penalized depending on which type of account it's in. So it's not too liquid. Inside of the TFRA, you have access to your cash value after 1 year. And when these accounts are designed properly, you do have access to the money after 1 year. The next pillar is rate of return. And of course, anytime we're talking about growing your money, we have to look at, what's the rate of return going to be? And inside of the 401ks and Roth IRAs, you're in the market. So you're probably going to average about 7.3% rate of return, which is the real return of the market over the last 30 years. The TFRAs, because it is inside of insurance, you're not going to have as much return potential. But remember, you don't have any downside. So your trade-off is a little less growth probably over time, but for protection from the market. And then because I'm losing my voice, Renji, why don't you take us through taxation and fees while I clear my throat?
Yeah, so taxation we talked about a little bit about with 401ks and IRAs, you have to worry about taxes, and it also depends on what tax bracket you're in. If you keep deferring it, you don't know what tax bracket you're going to be in and what the national income tax is going to be, right? So there's all of those things you got to look at. But with the TFRA, you don't have to worry about any of that. Just like a Roth, where you pay all that up front, so now whatever is in there is tax free, right? So, and then fees. The fees that we've talked about how it's if you compare it to like Kyle was to a bank account. Oh, going back to the taxes, if you compare that to a bank account, unless you have millions in your bank account, your growth is not going to be a lot, and you get taxed on the growth if it's more than a certain amount, right? With a TFRA, we don't have to worry about that. Now, going to the fees. Most bank accounts don't have fees. Of course, there are bank accounts with fees, but if there's a fee, there's some type of value they're providing. You get to do more with those accounts that have fees. It's just similar with the TFRAs. They do have a fee, but because it's inside of life insurance, it depends on your age and your health. So the older you are, just like any term or whole life, the cost can go up. And depending on your health, the cost can go up also. But the difference between this and a traditional, like a traditional term or a whole life is, with those, if you don't pay after a month or two, they can cancel the policy. With the TFRAs, if it's set up correctly, you would be overfunding it, so you're going to have cash value in it at all times. And if there's cash value in it at all times and it's growing with the market, they'll take the cost of insurance out of that. And as long as there's cash value in there still growing, it won't lapse for a long time unless it's set up wrong. If it's set up wrong, it will lapse pretty fast. And this is where we talk about the pros and cons. There's bad ways to set up these TFRAs too. There's wrong ways to set it up. But that's where you want to talk to someone that knows what they're doing and stuff. And I'm going to share my screen one more time and go over a few things that Kyle covered and something else. Okay, so this is one of the questions that I get a lot when we talk about a TFRA. Why haven't I heard about this before? Well, if you think about this, the government's not going to talk to you about something they don't profit from, right? Like we talked about, the TFRA or any type of life insurance retirement plan, those are in the tax codes. The government's put it in your face, but they don't talk about it because, again, they don't benefit from it. Just like a Roth IRA, they offer the Roth to you, but they put caps and limits on how much you can put in because they don't want you to put too much into it because they don't make any benefit from it, right? Stockbrokers, they love the stock market. They love 401ks and IRAs and stuff like that because they make a lot of money through the fees and all that they charge you. We actually partner with CPAs and life insurance agents and everything to help them set their clients up with more tax-free retirement. Unlike, and we talk about how not to put everything in one. We talk about adding a TFRA to your strategy because why not have more money tax-free and protected while you're working toward retirement, right? And then the last thing I'm going to show this, Kyle kind of went over this comparison a little bit, but with the TFRA compared to all other retirement accounts, you have no stock market risk. There's life insurance included. So with the 401k or an IRA, let's say you have 100,000 in there. The if they if the market, or let's say they borrow 20,000 out of it, I'll stop sharing so you guys can see me. Um, so yeah, let's say you have 100,000, you take out 20,000 out of it to put it for a down payment, or you take out a loan for something, right? The way the 401ks and IRAs work, you have to pay that back in a certain time plus interest. If you don't, God forbid you pass away, whatever is left over is what goes to your family, that 80,000 minus taxes, right? And not to mention, it's not protected in the market, so it can go up and down. Now with the TFRA, in that same scenario, let's say you saved up 100,000 over time. If you borrow 20,000, it's not coming out of your cash value, it's coming out of the death benefit. So now if you didn't pay it back and you pass away, your family still gets the 100,000 tax free, and they also get the death benefit minus the 20 that you borrowed. So they're getting an added cash bonus, all tax free. All of that goes to your family tax free, and it's protected from the market. So they're going to have that amount or more, whatever amount you put in or more, that goes to your family compared to a 401k. And then going back to before I share my screen again, Kyle, is there anything you want to add to anything we just talked about?
No, go ahead. Continue on.
Okay. Okay, so let me share again. Okay, so accelerated terminal benefits. So because this is life insurance, you have living benefits that come with it, chronic, critical, and terminal illness that come with it, and for no extra cost. And then the other living benefit is the being able to access the cash value, and to use it for whatever you want to. Loans, no prepayment required. Just like I mentioned before, with the 401k and stuff, you have to pay that back. Otherwise, you'll get penalized and taxed on it. It'll be just like you took that money out, so that because you're under 59 and a half, you have to pay the penalties and taxes. But with these, you don't have to pay it back because it comes out of the death benefit. But if you use it like we teach to buy passive income assets, you want to pay it back because you want to keep repeating that step again and again, just like it's your own bank. This is where the be your own banker or infinite banking concept comes into place because you are being your own bank instead of using the bank for these scenarios of buying assets. You can be your own bank in this scenario. Earnings are accessible before 59 and a half. We've talked about this plenty of times. With traditional retirement plans, you have to wait till 59 and a half. With these, you don't. And minimum distributions don't even matter here because this is all tax-free growth. They can't be taxed, so you don't have to worry about that. Earnings are tax-free. We talked about that. These are technically not considered as income because income can be taxed because this is tax-free money that you get in retirement, right? Net death benefit goes to tax-free to heirs. We talked about that. Last thing is cannot be altered by changes in law. And what that means is if you have a TFRA set up already, no matter what laws they change, you're grandfathered in. Yours it's a contract. It's a contract that's binding, right? So like they can't change it. But what we've also discovered is a lot of senators and governors and stuff have these in place, so they're not going to mess with it, which again, if they did, it won't affect them. But the reason they won't mess with it is then they can't set these up on their kids or grandkids, right? So they're taking their future generations away from having the same benefits, right? So those are just some of the things. I'm sure there's stuff we're not even thinking about that will come to us when we're not recording this podcast. But anything you want to add to that, Kyle?
Just as you're going through, like some other things to consider is that the TFRA only works if it's properly structured and maximum funded. And you need to work with somebody that's licensed and that knows how to do that. Not all, brokers or financial professionals know how to do that. But that's what Renji and I, that's what we specialize in, and that's what we do. And also, like regards to the fees, I've run comparisons and analysis before. If you look up TFRAs and IULs, people will say that they have high fees. But the thing is, if you look at it over a 20 to 30-year time horizon, the fees inside of an IUL would actually be less than what they would be inside of a 401k and potentially a Roth IRA, depending on what the fee structure is. But 401ks, for example, will average anywhere between about 1% to 2% fees, while the IUL over the course of 30 years will probably average between 0.5% of fee and also a 1% fee. Too often people just look at the fee up front. And yeah, in year one, the fee is higher than it would be in a 401k because the fee is based on a different component. Inside of 401ks and Roth IRAs, your fee is strictly dependent upon your balance in your account, right? And if you're starting with a zero balance, obviously the fees are going to be super low. The fee inside of a TFRA is based on the amount of insurance. So in year one, the insurance company could be on the hook for a $200,000 death benefit. So there's going to be some fees that are associated with that, right? But as time goes on and as you start to build cash value and start to grow, your fee is never dependent upon your account value. Whereas inside of 401ks and Roth IRAs, your fee is totally dependent upon your account value. So if we look at like 20 years down the road, 30 years down the road, it's pretty common to see inside of 401ks and Roth IRAs, your fees can be upwards of $10, $15, $20,000 a year, where inside of an IUL, your fees will never get that high if you have a properly structured IUL. And that's why we harp on and talk so much about the structure and the funding matters so much, because there's a difference between a properly structured IUL and one that's not. And so if you guys want to have something like this IUL or this TFRA for your retirement account, you need to make sure that it's actually designed to help you achieve your goals and your benefits. And the last thing I did want to mention and talk about before I turn it back over to you, Renji, is just the fact that like with Roth IRAs, you typically have limits of how much you can contribute a year. Whereas inside of a Roth, you can only do $7,000 in the year of 2024. If you're under the age of 50, you can only do $7,000 a year. And then also, if you're making more than $161,000 as an individual, or I think about $230,000 as a married couple, you can't even start a Roth IRA. There's limits to it. Using a TFRA in the IUL, there's no limits. There's no contribution limits. There's no income limits. This is why like the rich and the wealthy have used this for hundreds of years for themselves. But now it's become more and more relevant for the average everyday American to use as well. So if you're looking for more of like a holistic account to give you tax-free growth with stable returns that are never going to go backwards when the market crashes, and then also to give you access to your money before the age of 59 and a half, the TFRA can make sense. And we help a lot of entrepreneurs and business owners like ourselves set these up because they just don't have a 401k or anything through work, right? We typically recommend take advantage of your 401k match because that's free money. Anything above and beyond that, like contact Renji or I, And we can run the numbers to compare like which account is going to give you the greatest retirement income. 401ks may only give you $25,000 a year in income, but the TFRA may be able to give you like 34,000, right? And that means more income for you in retirement. And by the way, if you get sick or if you pass away anytime between now and retirement, there's a death benefit there that's going to pass on to your beneficiaries. Or maybe if you don't pass away, but you get sick, you have cancer, heart attack, stroke, there's living benefits built in where you can use your death benefit while you're alive. So it just gives you extra financial protection where you can access and use this money tax-free without penalties, without having to worry about the taxes. And you can truly like use the insurance company's money to help you if you were to have cancer, for example, God forbid, right? So just a couple other points I wanted to add in. And Renji, I don't know if you had anything else you wanted to add on top of that as well for you.
Yeah, while you were talking about the fees, something that I came to mind was I think you actually showed me this example, Kyle, of I think he was in his early 30s and he was putting like 4,000 a month into an IRA with his financial advisor, and his financial advisor said the IUL has too many fees and stuff, and I think you broke it down on the low end. If he was only paying the low 1% fee with a financial advisor over 20 years, with the financial advisor in the IRA, he would have paid over 101,000 in fees, and that's not counting taxes and not counting market protection. So he could still lose money, and he would still have to pay taxes. But with the IUL
Yeah.
that you were going to set up for him, he would have paid 27,000 in that 20 years. So 101,000 to 27,000. Sounds to me like the traditional route is a lot higher in fees, right? So,
Yeah.
but that's the thing, guys. It could vary. Like, it's not one size fits all. This is why we talk about how using this as a strategy to add on tax-free retirement income to your uh, retirement as a whole, or as we talk about on this podcast, passive income, buying passive income assets, using this as a route to do that instead of putting money into a bank where it's not growing, and when you take that money out of the bank to go put it into an asset, that money is gone. With an TFRA, though, if you use that same scenario I used as an example earlier, if you have 100,000, you took out 20,000 to go put as a down payment, your 20,000 still acting as if it was uninterrupted and compounding in the TFRA. So what that means is that 20,000 is not only growing in the TFRA, it's also growing in the asset that you bought. So your same dollar is making money in two places. That's awesome. Especially as an investor, that sounds great, because if I can make the same dollar make money in two places, why not? Right? Instead of a bank where you take that money and put it into an asset, now it's not in the bank anymore, it's in the asset. You're making money in the asset, but why not do something where you're making money in two places? Right? So that's the only thing I wanted to add. But yeah, guys, if you guys have questions, Kyle will link our social medias on here. You guys can go on there and schedule calls with us and look at one-on-one, because again, it's not one size fits all. We'll have to see what your goals are and see if this is something that you would want to add on to your portfolio or not. That's all I gotta say. Kyle, if you want to finish this off.
Awesome. Yeah, I think with that, like you said, message us to, determine if this may be a right fit for you. This definitely isn't a short-term get rich quick scheme or get rich quick strategy, right? This is definitely meant for the long term. It's meant to be a long-term retirement account that's going to save you on taxes, not have you exposed to any market risks, and to give you accessibility to your money if you want to use it before the age of, 59 and a half. And not to say that we recommend that you do unless you're wanting to use it to go and buy assets, because then you're accelerating your wealth and you're building wealth quicker. We love that idea, but don't use it to maybe fund, small or frivolous purchases, right? So use your money wisely, and with great power comes great responsibility. I think that was a quote from Spider-Man. But with that, if you guys have any questions for us on the TFRA, want to see if it's a good fit, feel free to drop your comments below or message us directly on our social media accounts that we'll have attached here. And as always, make sure to like, comment, and subscribe. And we'll see you guys on the next episode. Thank you for tuning in.